but want to welcome everybody. We want to quickly get through some introductions so that we can have plenty of time for the presentation and any questions that you're going to have. So if you do have questions, you look at the bottom of your Zoom window and there's a chat box there. You can click on that and put whatever questions you have there, and we'll get to those toward the end. So Fortress Federation and Spark Investment Group are partnering with Four Oaks Capital to bring you this opportunity, and it's an exciting opportunity. Now what that means, how we are partnering with Four Oaks, is we've co-vetted the market and the deal. We help provide risk capital, the earnest money for the deal, and we've performed due diligence, meaning that we walked all 167 units as well as done the lease audits for the current tenant base. We're going to be here to walk you through the entire process. Tonight, the star is Eric. Four Oaks Capital will be operating this deal, so that's why we have Mr. Eric Shirley tonight, who is head of acquisitions at Four Oaks Capital. Four Oaks currently has $21 million under asset management. I had the pleasure of meeting the guys at Four Oaks a few years back and can not only vouch for how good they are at what they do, but can say they are great, high integrity guys, and I look forward to continuing a relationship with them for many years to come. So hopefully most of you had a chance to go through some of the market highlights that we're excited about. The future job growth over the next 10 years is predicted to be about 40%. You probably read about Fort Gordon Cyber Command Center, which is going to be providing $2.4 billion annual impact to the region, which is amazing. And then the top industry in Augusta is healthcare, which supplies more than 50,000 jobs in the Augusta MSA. And they are also pouring in 1.8 million into the region. I wanted to mention just a word about the property management. The property managers, SDMC, they took over management of Windward, which is a property that Four Oaks now owns, and they took that property in November of 2017, and at that time it was 66% occupied, and by January of 2019 the occupancy come up over 90%, and it stayed between 91 and 97%. So while this isn't a heavy lift, it does require a bit of repositioning, so we all feel very confident and happy that SDMC is going to be the one that's going to drive that portion of the reposition. So quick intro on myself. My name's Rick Martin of Fortress Federation Investments. Bought my first single family back in 1997. Continued to invest remotely in places like Las Vegas, Palm Desert, Los Angeles, California. Done some buy and holds and fix and flips in the Midwest before transitioning into multifamily. And discovered the beauty of passively investing myself into syndications several years back, and now I'm up over 1,000 doors, and I'm going to continue to passively invest. In fact, I'm going to passively invest in this deal as well. And I also want to say, more recently, had the pleasure of meeting Mr. Arn Senindela of Spark Investment Group, who's also on this call here tonight. He's an extremely seasoned real estate investor, as well as an excellent human being. And I'm going to let Arn say a few things about himself, and then we'll turn it back over to Eric to get into the deal. Take away, Arn. Arn, you're on mute.
Oh, you're muted, Arn.
I'll get the hang of this. So anyway, thanks all for you showing up. And I'm Arn Senindela. Been in the real estate business since 1978, kind of a lifelong resident of the San Francisco Bay Area and Silicon Valley. Moved to Greenville, South Carolina about 6 years ago, actually 6 years to the day, November 18, 2014. Love it here, love the Southeast as a place to invest. Augusta, Georgia is about 2 hours from me. Been there twice. A few of the reasons, looking high level at this project, the things I look at is the purchase price is $42,000 a unit, which in today's multifamily market is almost unheard of. I've invested in syndications where we paid over $200,000 a unit. So $42,000 a unit's a very attractive price. The units average almost 1,000 square feet. So we're purchasing at about $43 a square foot, which again is below replacement cost. Um, the underwriting, which Eric will go through more in detail, is conservative. We are using a 7% exit cap rate. Many syndication deals that I look at today, they estimate cap rates at about 5.5%. And the way cap rate rates work, the lower the cap rate, the higher the sales price. So we're using a 7% exit cap, which will give a conservative value on resale. If in fact we're able to sell the property at a 6% to you. So I think the cap rate being very conservative at 7 is a key part of the transaction. The other part of it is we are just talking about raising rents to market over a 3-year period, and we have about a $1.35 million capital improvement budget to do that. I would just like to share a story. When Eric contacted me, I was, of course, interested in taking a look at the project. So I drove down to Augusta, looked at the subject property, and then went to visit the property owned and managed by Southern Management Company, who will take over the management of this property. So I got out of my car, was walking around taking a few pictures, and after about 5 minutes, a gentleman came up to me and said, hey, basically, hey, Bub, what are you doing? And I go, well, I'm looking down here for an investment, and I understand you guys will manage this property for me. So once I kind of explained who I was and why I was there, the gentleman, Ben, was very happy. He said, hey, go into the office and talk to Sarah and she'll show you a couple of our vacant units. The point of all this is property management on this transaction, on this project, is going to be very important. And my interaction with the property manager on the property they manage was very reassuring. They were clearly on top of the property, who lived there, who didn't live there. When they saw somebody strange on the property, they came to me and checked out and tried to find out why I was there. So I really have a good sense about the property management company. They're in this market. Their project is beautiful, extremely well run. It's a fine property. And so I have all confidence in Southern Management that they'll be able to do the same at Magnolia. So the price per unit, the very conservative exit cap rate, the raising rents to market, and the property management company, in my mind, is the 4 critical components of this syndication. Eric, take it away.
Yeah, thanks, Arn, and thanks, Rick. Kind words. We're excited to share this property with you. It's a really neat opportunity. So my name's Eric Shirley. I'm the Director of Acquisitions here at Four Oaks Capital. And in the last 12 months, this will be our 8th asset that we have purchased. As Rick had mentioned earlier, just over 21 million in assets in 2020, as well as 500 units that we've acquired in the past 12 months. So the reason that we're excited about this property is it's very unique compared to the other 7 assets we've brought into our portfolio. It is everything else that we've bought. The goal is to take a underperforming asset and move it from a certain class or a certain type of property and rebrand it, reimagine it, and turn it into a higher level of asset. And we don't have to do that with this property to be successful. With this property, you'll see through the conservative underwriting and the rent comparables that we're using, all we have to do is be mediocre. All we have to do is hit status quo, and we're going to absolutely knock the cover off the ball. And there's so much room for upside that we'll get into tonight. So I want to quickly run through the deal, tell you a little bit about the team that's involved on this. Let me share my screen here. All right, can you guys see my screen on?
Yes.
All right, perfect. So we're going to be talking about Magnolia Park Apartments, and Magnolia Park is 167 units in Augusta, Georgia. And Rick talked a little bit about Augusta. Augusta is just a really neat market, and we'll touch on that in a few minutes. I grew up actually in this neck of the woods, and Augusta, a lot of people don't realize, it's the second largest city in Georgia behind Atlanta. So it is a big city. It has a lot of things going on that are positive beyond just the Masters. Shout out to Dustin Johnson, who's a Columbia, South Carolina native, winning the Masters this weekend. But Augusta is way more than just a golf course. And we'll touch on some of those key things about Augusta that make this property and this market so intriguing. As we mentioned earlier, it's 167 units. The purchase price is $7.15 million. The strike price on this, which is the price that the sellers wanted, was actually $7.6 million. We were able to negotiate the price down to $7.15 million. I just found out recently that they have a backup offer of $7.8 million currently. So if we fall out of contract, which we won't, but if we were to fall out of contract, there's someone that's felt confident enough in this property to come behind us and put a $7.8 million offer in play. This property actually appraised in 2018 for $7.4 million. So we have this property for $250,000 below a 2018 appraisal. Now, why is that important? Well, obviously $250K in instant equity is a beautiful thing for any investor. But even more importantly than that, there's been some massive shifts in the market since 2018. It's become even more of a seller's market. So cap rates have continued to compress. And to what Arn said earlier, the lower the cap rate, the higher the sale price. So in reality, if this property appraised at $7.4 million in 2018, and we're 2 full years later, there's a very high likelihood that this property would appraise in the low $8 million range today. So we are getting this for a very, very, very good price. Total capital raise. So our capital raise includes several things. It includes the down payment for the loan, and this is a loan assumption, but we do have to cash out the buyers for their equity in the property. It includes an acquisition fee, it includes closing costs, and includes our capital improvements budget, which we call a CapEx budget. And we'll run through all of that in a little more detail in the underwriting. Our projected returns, this is a 6-year hold. We're looking at just shy of 17% average annual return, which is going to ultimately be a 2-time equity multiplier. So if you were to invest $100,000 today, at the end of 6 years, you get back your original $100,000 investment plus an additional $100,000. It's a 13.4% internal rate of return. Minimum investment is $50,000 and the maximum investment for this is $450,000. From a general partnership standpoint, so myself and my Four Oaks brethren, as well as Arn, Rick Martin, and a couple of the other folks that are helping us on the capital front, we have over $1 million on the GP side invested in this deal. So of the $4 million capital raise, over $1 million of that has already been contributed by ourselves. That should give you great peace of mind that we believe in this deal wholeheartedly. We invest in all of our deals, but to already have $1 million of a $4 million raise spoken for by the general partnership should instill great confidence in what we think about the deal. I want to touch just really quickly on our Four Oaks team. Brian Briscoe is our director of marketing. He handles our podcast. If you haven't heard our podcast, check out Diary of an Apartment Investor. Brian handles our podcast, all of our social media presence, and kind of that marketing arm. Todd Butler, Todd and I work very closely. We work very closely together. He's our director of asset management. So I acquire the properties. I bring them all the way through the process to closing. And then once we close, Todd takes over the management and works with property management to make sure that our property management team is executing the business plan properly, to make sure that they're hitting the metrics and really hitting the mark for you, the investor. We have Brian Mallon. Brian is our director of investor management, but he does so much more than that. Brian's an invaluable member of the team, but primarily if you're investing in any one of the Four Oaks deals, in any capacity, whether it's through Spark or through Fortress Investments, you're going to deal with Brian. He manages our investor portal. He's in charge of all of our reporting. We have Kelsey Bailey. Kelsey's a data analyst for us. She helps determine what markets we're going to invest in. She helps me and our acquisitions team with our underwriting. And then last but not least, not pictured, is Deb Pritchard. And Deb is a CFO that we just brought on last week. Deb is one of the top real estate accountants over the past 30 years in multifamily real estate. And she's winding down her career as an accountant. I wanted to get involved more specifically with an individual company, and actually approached us a couple months ago and said as she was phasing out of her accounting background, she wanted to see if she could join forces with us as our CFO. So we're extremely pleased to have Deb join our team. Not only is she going to be a great asset for the Four Oaks team, but also you as an investor, she'll be able to answer any questions you have about K-1s, taxes, 1031 exchanges, pretty much anything and everything that involves a financial aspect. On the investment side, Deb is going to be a phenomenal resource. So we're extremely pleased to bring Deb into the fold. So that's kind of a high-level overview of the Four Oaks team. Rick, I stole your investor packet here, so that's why we have one for Arn as well, but this is Rick's.
That's a good one to steal. I like that.
Yeah, right? So Augusta, let's talk briefly about Augusta. I don't want to spend too much time on this because Rick hit kind of the key points, but Augusta's growing. Augusta is a booming tertiary market, and Augusta is comprised of really three big economic drivers: cyber and this new cyber command center. As Rick had mentioned earlier, it's going to bring $2.4 billion with a B. It's going to have $2.4 billion annual economic impact in Augusta. Now, while the people that employs are at a higher caliber and a higher level than the tenant base that we will be targeting at this property, what it does is it generates a tremendous amount of money in the economy. And so where our tenant base is going to be primarily working in hospitality and food and beverage and retail sectors, well, all of those things are going to get positively impacted by high-paying jobs. You're going to see an increase in retail jobs. You're going to see an increase in food and beverage jobs. You're going to see an increase in hospitality and tourism, especially an influx of business travelers as well. So it's going to be huge for this market. The second thing that's really cool about the Augusta market is Fort Gordon. So Fort Gordon is a massive Army base in Augusta that employs over 24,000 people. So it's the single largest employer in Augusta, actually in Richmond County as a whole. So Fort Gordon has a tremendous economic impact on this market. Manufacturing is a smaller piece of the pie, but a lot of people don't know 90% of all the world's golf carts are made in Augusta. So EasyGo has a plant there, as well as, I'm blanking on the other big golf cart manufacturer, but they're both based out of Augusta, which is pretty neat. And then last but not least is the medical side. And there's 8 major hospitals in Augusta, one of which is a teaching institution, which means it has a medical university associated with it, as well as a level 1 trauma center. So for those of you that don't know me, I actually have a medical background, and having a level 1 trauma center in your area is huge. They have one of the top oncology centers. They have one of the top burn centers in the country. Actually, the burn center is one of the top in the world. They have a phenomenal pediatric hospital. And what's really interesting is Augusta has more doctors per capita than any other city in the world. That's a fun fact. I did not know that coming into this. So now you all know for when you watch Jeopardy, when they ask that question, you'll be well prepared. So Augusta is a great market, and it's growing. And that's one of the big key indicators that we look for in any market is growth. We want diversification of employment. So we don't want a Detroit where, the auto industry dominated Detroit. So Augusta has some really nice breakdowns between medical, cyber, technology, manufacturing, defense. Those are some really nice broad buckets to diversify the employment in that MSA, which is a positive thing. We're looking for a reduction in vacancy, which we have. We're looking for employment growth, which Rick mentioned earlier. They're looking at 40% employment increase over the next decade. And we're looking for population growth. And you can see Augusta's seeing significant population growth. And the bulk of that is millennials. And guess what, folks? Millennials are renters. That's who we want. Millennials are going to be coming in renting. Traditionally, when you get the 35 to 50 range, those folks are buying houses. So that's just a little bit about Augusta. I want to kind of switch gears and dive into the underwriting, because I think this is really the meat and potatoes of what makes this deal so special. And I'm going to walk through this at a pretty high level. I'm going to be fairly quick. I get really excited when I talk numbers. I'm a nerd like that. So if you have questions, jot them down in the questions section. We will get to them. We'll make sure all questions are answered, but I'm going to dive kind of right in here. So it's 167 units, as we mentioned earlier. There's 12 one bedrooms, 149 two bedrooms, and 6 3 bedrooms. That's a really great unit mix. So 2 bedrooms are the most sought after unit type in all of multifamily. And not only do we have 149 of the 167 units are 2 bedrooms, but 100 of those are townhouse style 2 bedrooms. So as opposed to having a neighbor upstairs and a neighbor downstairs, you have free reign from top to bottom. You just have neighbors on each side. And those are extremely, those command a lot of demand. So because they're at high demand, you're able to charge rent premiums for that, which is going to be huge. You can see the actual rents currently are $598 for the 1 bedrooms, $626 for the 2 bedroom 1 baths, $650 for the 2 bedroom 1.5 bath townhouses, and $774 for the 3 bedroom 2 baths. You can see over here what we're going to be pushing rents to, and that's going to be important. I'm going to touch on that in just a second. But you can see our rent bumps are very, very nominal at best. We don't have to do these massive $200 and $300 rent bumps to achieve really, really impressive numbers on this property. And the last thing I want to point out on this slide is the size of the units. So the 1 bedrooms are average size, 700 square feet for a 1 bedroom. It's on the larger end, but it's on the larger end of average. But when we start getting into 960 square foot and over 1,000 square foot for the 2 bedrooms, those are extremely spacious units. So not only are we going to be very competitive on pricing, we're going to be very competitive on pricing with really, really large spacious units, which is just going to further increase the demand. And then last but not least, you can see the 3 bedrooms are topping out at 1,100 square feet. So those are massive units. My first house was barely 1,100 square feet. So I can't imagine being in an apartment that was that large. So let's take a look at the kind of the assumptions on this deal. So we talked a little bit earlier about the purchase price. It's $7.15 million, well below appraised value and even further below what today's appraised value would be. Our renovation budget, we have a $1.35 million CapEx budget, and I'm going to dive deep into that on the next slide. Fees, it's very customary in this to charge a 2 to 3% acquisition fee to the management team, and we have a 3% acquisition fee baked into the deal. We have $200,000 in cash reserves. So that's extremely conservative, guys. Traditionally, most syndication groups will budget between $500 and $1,000 per unit for cash reserves. So that would be anywhere between $80,000 and $160,000 for cash reserves. We actually have about $1,200 a door budgeted, and that's going to allow us the cash reserve cushion to weather anything that comes our way. So when we really think about it, we're in the midst of 4 things right now. We're in the midst of a global pandemic. Because of that, we're in the midst of a CDC eviction moratorium. We're in the middle of an election year, and who knows how that's going to continue to pan out over the next couple months. And then last but not least, we're in the tail end of a market cycle. And I'm a big believer in the study of economic history. And as we all know what happened in 2008 through 2010, I certainly don't think we're looking at anything that extreme, but we are at the tail end of a market cycle, and we continue to be in an unbelievably strong stock market. And there's a lot of things going on that just aren't sustainable. And at some point, there's going to have to be a reset. So being conservative and having strong cash reserves when you're doing these deals is so important right now, just to be in a place of cash strength. And then we have $163,000 budgeted for our closing costs. That brings our total all-in cost to just under $9.1 million. This is a loan assumption. So complete candor, these are not attractive loan terms. The group that we're buying this from, it's 6 Israeli brothers. And when I say Israeli, they live in Israel. They have 11 other properties in Atlanta. And this is kind of their black sheep because it's 2.5, 3 hours from Atlanta. So every time they fly in from Israel quarterly to do their property reviews, they do everything in Atlanta, and then they have to drive all the way down to Augusta. They get no operational efficiencies because it's far enough away from Atlanta that they aren't able to take advantage of the proximity to other properties. So it was just a good time for them to get rid of this. So they priced it aggressively, and we were able to negotiate that price down even further. But it is a loan assumption at a 5.07% interest rate. It is a 10-year loan term, of which we are 2.5 years into the loan, and it does have yield maintenance. If you're not familiar with yield maintenance, that's a prepayment penalty. That's basically a summation of the rest of the interest payments. So the reason that this is a 6-year hold is we have to get to the tail end of the loan cycle so that we're not paying a massive prepayment penalty by exiting early. That said, if we have a chance, if someone comes in and offers us a ridiculous sum of money to exit sooner, we will absolutely do that if it makes financial sense for you, the investor. But all of our pro forma numbers, and you'll see we underwrite things a little bit differently than a lot of folks. We present what's called a stress tested or a doom and gloom underwriting model. So we're going to show you some crazy vacancy numbers, some crazy conservative numbers that just leave a tremendous opportunity for upside. That doesn't necessarily mean that we expect the property to operate that poorly. We're just baking in these low numbers so that we can underpromise and overperform for you, the investor. And you'll see that in the returns. We'll touch on that as well. So we're going to be assuming this $5.1 million existing mortgage, which brings our total equity raise to 5.958, which we're rounding up to the total raise that we're raising is going to be 3.975. So we're actually adding in about $17,000 of buffer here. As I mentioned earlier, the interest rate is 5.07. There is no interest only period. So we're going to be paying principal and interest right out of the gate. And it is a 30-year amortization on a 10-year term, of which there's about 7.5 to 8 years left. So let's run through the CapEx budget real fast. So as I mentioned earlier, we have a 1.35 CapEx budget, and here's kind of what we're budgeting for. So we have $100,000 budgeted for roofs. So some of the roofs have already been done. So you can see over here, these are the remaining roofs that need to be done and the quotes from Columbia Siding and Roofing for those. We had $100,000 budgeted. We have $99,165 quoted. So we've come in below budget on every single quote we've received thus far. And all of our quotes have a little bit of fluff built into them. We always ask our contractors to build in 5 to 10% of overage just in case. Siding. So there is some areas of this property that have mansard roofing, and as well as some siding at the back doors of the townhouse units. We're going to replace all of that siding and replace the asphalt shingles that are if you're familiar with mansard roofing, it's when asphalt shingles kind of come down the side of the building. It's a very 70s look. It's very much in line with like that gold yellow color and avocado green interiors. But that's called mansard roofing. This is when the shingles come down. We own multiple other properties with mansard shingles and mansard roofing. What we've had a tremendous success doing is ripping the asphalt shingles off and replacing that on the side with board and batten vinyl siding. And it actually looks like a aluminum metal roof. It looks great. It adds a very cool, hip, modern flair, and it's really easy to take care of. You don't have to worry about shingles peeling up or blowing off. All you have to do is pressure wash it once in a blue moon. So super low maintenance, gives it great curb appeal. We had a $125,000 budget for that. Quote came back in at $120,000. Vinyl shutters. So we had Columbia Siding quotas for the shutters. Arn and Rick can tell you they were on site when we did our due diligence. The shutters that are there now are actually in pretty great shape, and they are vinyl shutters already. They're black. A couple of them might need some paint touch-ups, but for the most part, they look great. So I don't think we're going to need to replace those. Wood rod around the doors. We have budgeted for $25,000. We have a $50,000 budget for amenitization. That's the biggest downside that we saw about the exterior of this property is there's really no amenities. There's a ton of kids. There's a playground, and that's a very generous term that I'm giving what they have, and they're calling a playground. It's literally like 2 swings, a freestanding slide, and like an igloo-looking monkey bar thing. It's kind of sad. So we're going to replace the playground. There was a pool here many years ago that they filled in, and now it's just a concrete slab. We're going to cover that with like if you're a college football fan, it looks kind of like the Boise State football field. It's like a blue AstroTurf that they can actually put like games on, like hopscotch squares and foursquare. It's really neat. We looked at putting in a splash pad, and it just wasn't going to be economically feasible. So we are pivoting from that. Awnings. They currently, so in the units that are not townhouse units, the other 67 units, Those are traditional units where you would walk into a hallway inside, like you walk into a single hallway on the inside of the building, and there's units that branch off from that interior hallway. So at each one of those buildings, there's currently a canvas awning, and the canvas is just in disrepair. It's tattered, it's faded over the years. So we're ripping all of that structure down, and we're putting in a new permanent powder coated aluminum product that's going to still offer the same coverage as an awning, but it's going to look really, really nice, and it's going to be much more durable, have a much more modern, not 1970s feel. Landscaping, Arn and Rick can attest, the landscaping is actually in pretty darn good shape out there. There's some beautiful magnolia trees. We're just going to add in some pops of color. So we're going to do some flower beds and just some things that really give it some nice curb appeal and make it pop. Those same buildings I was talking about with the awnings, there's a need to put, they have that old industrial peel and stick doctor's office tile that's yellowed, and it's disgusting. So we're going to rip all that up, put in LVP vinyl plank flooring, that same flooring that we're going to be putting in the units themselves. It's going to look fantastic. We're going to have the units pressure washed. And then last but not least, we're going to put a fence around the entire property. It's a wrought iron fence. Looks really, really nice. If you have the investor packet, you can look in the investor packet and see pictures of what that will look like. And we're actually going to have gated access put in as well. So the tenants are going to be the only ones that can get in with like a key fob. And then there's going to be a place where you can buzz, and it would call the tenant on their cell phone, and they would answer and be able to buzz you in. So that way we can restrict the access of who's coming and going. A, it's a great security feature, and B, it just adds a sense of security and safety for the resident base. That's just going to make it feel safe and homey and really feel like a great spot. The interior budgets, we've budgeted by unit and by the unit size. So we actually have a contract with both Mohawk and Shaw for flooring. We're able to get both carpet and LVP, industrial grade LVP for multifamily at about $1 a square foot. And then our flooring installer is about $1 a square foot for installation. So whether it's carpet or LVP, we're looking at about $2 installed, which you can see that's factored in here. Cabinets. A lot of times we'll replace the cabinets if the boxes are good, we'll replace the faces with what we call a cinch kit, and it's shaker doors. But we don't need to do that with this product. We know our demographic here. This is a C-class product with a C-class tenant base. And we're not trying to pretend it's anything it's not. So we don't need to put in the fancy upgraded countertops and the fancy upgraded cabinet doors to get that. We just want fresh, clean, modern looks without overspending for our clientele. We are going to replace the countertops. They've painted a lot of them gray, and we don't love the idea of painted countertops. So we're going to shift that to like a faux granite looking Formica countertop. New kitchen faucets, new light packages. Right now they have the old gold brass fixtures. We're going to replace all that for satin nickel finish. Doorknobs, fans, lighting fixtures, all of that will be satin nickel finish. A lot of times we'll do 6-panel doors in these types of properties, but as I mentioned earlier with the cabinets, we just don't need to spend that kind of money to get the upgrades in rent price that we're looking to achieve. So there's no need to overspend. And if someone wants to come in after us, we're technically leaving meat on the bone for them to approach this as a value add for themselves. Paint, we have a phenomenal painting company that'll come in. They'll paint the ceilings and the walls for about $600 a unit. Replace all the outlet covers and GFIs where needed. Doorknobs, as I mentioned, satin nickel finish. Mini blinds in all the units. Nate, who is our maintenance supervisor, he actually owns a company on the side that refinishes tub tile, and he does a phenomenal job. And so we're budgeting in all of the tubs have the original tile. So it's not inserts. It's really nice tiled showers and bathtubs. And he can come in and refinish them at a fraction of the price that we pay an outside company to do that. Replace the bathroom faucets and then vent fans. Most of the units, again, Rick and Arn can attest, had great, the appliances were in great shape, but we do have budgets to replace all the appliances in all the units. So we feel like if anything, we're overcapitalized, but again, with the current economic state, it's never bad to be in a place of overcapitalization. Let me get back to my underwriting here. So in addition to the capital expenditures that we're going to come in and the capital improvements that we're going to make, all of the windows were replaced by the current ownership group. So all of the windows are brand new double pane energy efficient windows. The parking lot's been completely redone. Half the roofs have been replaced. And then one of the biggest changes that this group made is the current loan that they have is a Fannie Green loan. So what that means is they have to add energy efficient things to the property to make it qualify for this Fannie Green loan. So they partnered with a company called SAS. Kelly calls herself the potty princess, but they came in and they put in ultra high efficiency toilets, 0.8 gallon per flush, Niagara toilets, ultra high efficiency shower heads and ultra high efficiency faucets in every single unit. Spent $200,000 putting in all this ultra high efficiency stuff. What they didn't know when they did it was a lot of times 70s vintage product does not have the plumbing to accommodate ultra high efficiency fixtures. So they ended up having to rip out the entire sewer lines. Let me add someone here. Sorry, we had someone. They ended up having to rip out the entire sewer lines and replace them, which is to our benefit. So we're super excited about that. That's just going to, further add to what we're doing at the property, and it's just extra upside for us. So let's take a look at the meat and potatoes now with the so we talked about CapEx over here, $1.35 million CapEx budget. Let's talk about the pro forma now. And this is what we're really excited about. So when we talk, first and foremost, when we talk about rent bumps and what we're trying to do with rent bumps, let's look at what we're doing and where we're trying to go. So like earlier, we talked about the one bedrooms. They're currently at $598. So what's neat about this property is there's 12 comparable properties within 2 miles. And all of those comparable properties were built between 1965 and 1985. So they're right in the mix of age, kind of the same age range. They're all C properties for the most part, C location properties, and they're all close. So we have some really, really good comps to pull from. And Rick mentioned earlier, our management company, SDMC, actually owns High Point Crossing, which you can see right here. It's 1.6 miles away. Not only do they manage that property, but they own it themselves. So they have a phenomenal grasp of this specific submarket in Augusta. But when we look at what we're trying to push our rents to in 3 years, this gray line, this is our 3-year rent projections. So I'm gonna say that one more time because that's how important this is. These are our 3-year rent projections and where they fall in line with today's comparable rents. So in 3 years, our one bedrooms, we're aiming to get $655. That's dead smack in the middle of what all of our comparable properties are getting today. I can't tell you how insanely conservative that is. All we have to do is be mediocre, middle 50% today in 3 years. That's crazy, guys. I can't tell you how you just don't see deals where you're able to be that conservative. The 2 bedrooms, the meat and potatoes of this property. So we're trying to push rents in 3 years to $730. Look at where this puts. It puts us in the middle 50%. We're 6 cents below the average price per square foot today with our 3-year rent projection. Crazy. The 2-bedroom, one and a half bath townhouses. Again, we're saying we'll get to $785 in 3 years. That puts us right in the middle, actually in the lower, below 50% mark. That's crazy. And then last but not least, the 3 bedrooms, again, middle to below 50% mark. So I can't tell you guys how conservative that is. And you'll see in our numbers, that's one of about 6 different areas that we're being hyper conservative. And we're still offering a 17% average annual return with these 6 areas where we have a tremendous amount of opportunity to outperform.
Yeah, Eric, I was just going to mention that, of course, you're going to test market at higher rents. This is just
absolutely.
This is just our threshold that we have to meet to achieve the returns that you see on the investment summary.
Yeah, and as we dive into the pro forma, again, keep in mind, a lot of folks want to throw around this term conservative underwriting, and this really puts a bee in my bonnet. I sound like my grandmother here. But where it really frustrates me is people throw around the term conservative underwriting all willy-nilly. And the reality is that they are being conservative, but not really. So Augusta, if you look at those comparable properties that we were just looking at, the average vacancy rate is 6%. So if I came in and showed you, hey, we're going to model at 8% and the average vacancy is at 6%, technically I'm being conservative. I'm below average, right? Let me show you what we're doing with vacancy. Year one, we're factoring in a 25% vacancy rate, 14% physical, 11% economic. Do we think this property is going to have 25% vacancy? Absolutely not. But we're building that in because we don't know what the next 12 months are going to look like. We don't know what the CDC eviction moratorium is going to look like. We don't know what COVID is going to look like. And we would much rather build in this massive cushion and under promise and over deliver for you, the investor. But just because you see these hyper conservative numbers, don't think that that's what we're trying to achieve. We're trying to outperform that. So year one, 25% vacancy, year two, 15% vacancy, year three, 12%, and then 10% year four and moving forward. That's super conservative, folks, in a market where the comps are seeing 6% vacancy. Our rent bumps, current rents right now. So when we first underwrote this, average rents were at $642. Rents have come up in the past few months, so right around $650 currently. We're modeling at $660. That's below inflation. Inflation over the last 25 years has averaged about 1.9 to 2% a year. The Fed's done a really nice job with inflation handling. So our year one rent growth is below inflation. That's pretty darn conservative, folks. Year two and year three, we're really starting to push rents to those metrics that we showed you when we were looking at the comparables. And then it flattens off and we're looking at a 1.5% average annual rent increase. Again, that's below inflation. So we should be really, really conservative with that number. Anytime you can be below inflation, you're being hyper conservative. So our gross potential, so this top section here, we're looking at percentages. The second section right here, we're getting away from percentages and we're looking at the actual quantification of that percentage and the actual numbers themselves. So we have $320,000, $330,000 of built-in vacancy in year one. So you can see that our net rental income will be $990,000. So commercial income is RUBS. Currently, they're charging about $18 to $20 per unit in RUBS. If you're not familiar with RUBS, it's a utility billback system. So the tenants are paying for their own electricity. Each unit's individually metered. And then we, the landlord, are paying for water, sewer, trash, and pest control. And we're including that in the rent. But no more. We're going to start billing those things back to the tenants. So you can see over time that RUBS is going to increase from $20 up to about $35, $40, and that's the $65,000 mark. We're going to do that gradually over a 3-year period. But here's where, again, to speak on how conservative we're being with our underwriting in year one, that brings our total income in year one to $1.1 million. Their T12, their actual performance over the last 12 months, they did $1.2 million. So we're $100,000 in our year one projection below what they've actually done over the past 12 months. That's crazy. We have outperformed every single deal at Four Oaks. We are outperforming our projections on every single deal that we have under our management. And in this case, we're saying we're actually going to do worse than they did last year. That's super, super conservative, folks. So payroll. Payroll, we're looking at $170,000 for payroll. So we have a full-time leasing agent, a part-time leasing agent. We have a full-time maintenance supervisor, a full-time maintenance technician, and a part-time maintenance technician. That's what that $170,000 will comprise. 4 full-time employees and 1 part-time employee. Property management fees. Disregard this percentage right here. Our property management company, SDMC, charges a flat rate. They charge $25 per month per unit. And the reason that you see that number not climbing like the rest of these numbers, the reason you see that number staying steady is we've actually signed a contract for this property that lasts the length of our ownership period for that exact price point. SDMC manages over 4,100 units throughout the Southeast. They have the property right down the street, and they manage all of our assets at Four Oaks. As I said earlier, we're outperforming our pro forma numbers on every single property we have. In some cases, one of our most recent acquisitions in June, if you annualize out over the last 5 months, our T12 off of an annualized T5. We're on pace to hit our year 3 NOI projections in our first 12 months. SDMC is no joke. They do a fantastic job. We're proud to have them as our management company. General and advertising, you can see they had a previous budget of $36,000. That included advertising. We broke advertising out. We are big believers with advertising of what we stick to the basics. So we pay $300 a month for apartments.com. And that's what you see here with the $3,600 budget. Other than that, we've had tremendous success with Craigslist and Facebook Marketplace, as well as just word of mouth. We do offer some referral-based programs on site. G&A for the $32,000, that's right in line with what they spent previously. Repairs and maintenance. This is another area where we're being hyper conservative. So we're budgeting $600 per unit per year. That's right at 10% of the expense budget is going, or 10% of our expense budget is going towards repairs and maintenance. Here's why that's hyper conservative. Folks, we're about to put a $1.35 million bolus of capital into this project. There's no way that we should be spending $600 a unit in repairs and maintenance, considering the amount of money that we're about to put into the interiors and exteriors of all the units. We should absolutely crush this number, and I'm excited about that. Contract services, that's janitorial and pest control. Grounds management, that's our landscaping contract. All of those contracts are already in place, and we're taking those over. So we expect those to stay stagnant. Eviction fees, we're mimicking what they have here. We expect our eviction fees to drop because we are going to be, as we improve the property, we are going to be pushing towards a little bit higher caliber of tenant. We understand the demographic that we're looking at, but we're still going to be aiming towards the higher end of that demographic and that clientele. Also, one thing to point out with evictions, Augusta has one judge that does all of their eviction courts. He is very pro landlord. So even with the CDC eviction moratorium, the tenant has one shot to come in, and if they aren't able to provide 100% of the required paperwork to qualify for that CDC eviction moratorium, the judge tells them to get out and they get the boot. So the judge is extremely landlord friendly. That said, we are big believers in payment plans in times of things like global pandemics. So we are not trying to kick people out if they are making an effort to do the right thing and come up with a payment plan and work with us help them. By all means, we want to keep them in place. For those folks that are saying, oh, I don't have to pay rent, oh, there's a CDC moratorium, screw you, I don't have to pay. We have something else coming for them from this judge. So it's always great when you have a landlord-friendly judge that handles all of your evictions. Utilities, as you can see, we're keeping our utilities exactly in line with the last 12 months. Trash removal, we're keeping the same trash contract. Insurance. So this is another area where we're being conservative. So the current insurance is at $364 a door. We already have a quote back from our current insurance carrier. So we have a portfolio policy through Travelers for our multifamily assets. We're able to tie this in, and we've already been quoted right around $250 a door. So that's another number that's going to come down, that when we built in our original underwriting, we chose to keep it there to build in a cushion because insurance prices are going up. But we feel extremely confident with our multifamily policy based on the quote we've already received that will be below that number. And then taxes. This is another area that we're going to be able to overachieve. So as of right now, the taxes are $83,000 a year. They are being appealed by the current ownership group. During the appeal, the bill was dropped to $65,000. So if they win the appeal, the taxes will stay at $65,000. If they lose the appeal, they're going to go to $83,000. Either way, once that appeal verdict is handed down, one way or the other, the taxes are locked in for the next 3 years. So we're either going to have $65,000 taxes or $83,000 taxes for the next 3 years. You can look at our underwriting, and we anticipated them going up with our purchase, but we know, so of those 3 years that are going to be locked in, one of them is 2020. So we're not going to be able to take advantage of that. That year's almost gone. But for the next 2 years, we're either going to be at 65 or 83. And so this 1 year, right now, if it's 83, we're going to get a nice $20,000 tax savings here. If it drops to 65, we're going to get, you know, an $18,000 tax savings in year one and a $40,000 tax savings in year two, which is massive. These are all areas where we have massive chunks to be able to outperform for you, the investor. Our expense ratio. So this is a little unique. The way this template's modeled is our expense ratio actually goes off of the gross potential rent. If you look at this, if we were to actually change that from gross potential rent to the gross income in general, you can see the expenses jump up to almost 60%. So, and that doesn't even include our annual replacement reserves of $250 per unit per year. So we are being very, very generous with our expenses on this property. The other thing is we know how High Point Crossing, the property that's very similar in age, vintage, and location that our property management company operates right down the street. So we're very, very confident in our ability to operate within these boundaries numerically because our property management company is doing it right down the street. As Arn mentioned earlier, we are exiting at a 7 cap. So if you look at all the deals that traded in 2019, there were 12 deals that traded in Augusta in 2019. The mean cap rate of those 12 deals was a 5.7% cap rate. So traditionally, to be conservative, you add in 10 basis points per year of hold. This is a 6-year hold. So logically, you'd add 60 basis points to that 5.7. So in 6 years, we should be modeling conservatively to exit at a 6.3 cap rate. Guys, we've added in 22 basis points per year of hold. That's exiting at a 7 cap. That is another area that we're just being absurdly conservative for you, the investor. So when we take a look at the actual numbers, it's a 6-year hold, 3.958 cap raise, 80-20 split, and there is a hurdle where it goes to 75-25. Let me go ahead and address that because I know I'm going to get questions about how that hurdle works. So basically, we feel like we front-loaded the interest in this for the investor, as it should be. So it's an 80-20 split where the bulk of the proceeds, 80% of the proceeds, are going to the investor. With that said, once we hit a 12% average annual return, all right, so this is a 6-year hold. 12% per year for 6 years is a 72% return. So once you, the investor, have seen a 72% return on your investment, then the model shifts from 80-20 to 75-25 for the remaining portion of the deal. That's basically a way of us saying, hey, look, we front-loaded your interest on this, but we would like to get paid nicely on this too for doing a good job. And so we're basically getting a back-end bonus on this of once you get 72% total return on your investment, the equity split shifts slightly, and we get a little more equity on the back end as a general partnership. The only way we could do that prior to selling is if we hit a 12% average annual return, or excuse me, a 12% annual cash on cash, which we will not do on this property. It's very rare to find a 12% cash on cash annual return property. So the only time we'll hit that metric is when we sell. So when we get into the numbers, let's talk about cash on cash return. So it's a very poor cash on cash return year one. The reason for that is we baked in 25% vacancy. We were coming in $100,000 with our income below what they did last year. And we're doing that to be hyper conservative because we don't know what COVID's going to bring over the next 12 months. That causes this abysmal 1% average or 1% cash on cash return in year one. If you take that out of the equation, and I know we have to factor it in, if you leave it in, it's about a 7% cash on cash return over the 6-year hold annualized. If you take that away, it's closer to an 8% cash on cash return over the next 5 years. The average annual return on this deal is 16.9%, 13.4% internal rate of return, and a 2-time equity multiplier. That is with the hurdle, and that is with all of those conservative aspects that I spoke of just a minute ago. So the opportunity to outperform on this is massive. If we average 10% vacancy over the 6-year hold instead of 25, 15, 12, 10, 10, 10, if we average 10 from year one and we took our cap rate down from 7% to the 6.3% that's deemed conservative in most circles, you would see a 22 to 23% average annual return up from a 17%. So there's a ton of upside here. We would just rather, here's how I always say with this, because I get asked a lot of questions about this. If I told you, hey, if I modeled this with all the shiny object syndrome and tried to woo you and said, hey, I'm going to give you a 22% average annual return, I came in at 20%. You're going to say, Eric, 20% is great, but you told me 22 and you didn't deliver. And you're right. You're going to be caught up on the 22%. Even though 20% is phenomenal, you're caught up on the 22%. But if I tell you 17% and I delivered 20%, we look really, really good because we've outperformed. And that's what we would much rather do for you. We do perform a cost segregation study, which will be conducted this calendar year, assuming we close before the end of the year. And we do pass through those tax benefits to you on your K1s. So that's this deal in a nutshell, folks. I know I get excited about this. I know I went through it in great detail, but let's pull up. I know we have a ton of questions here, and I'm going to get to them all. All right. Let's see. Questions. Cash reserve requirements of the lender. Great question, Philippe. So cash reserve requirements are not required on a loan assumption. So that's another huge benefit of doing a loan assumption, despite the less than favorable terms, is we don't have to worry about any reserve requirements. Right now, they're requiring anywhere between 6 months to 18 months of payments, principal interest payments, which is a massive front-loaded reserve, but we don't have to worry about any of that. Nope, to answer your question about lenders' reserves have to be maintained throughout the ownership, the answer is no. Rick answered that. Sorry, thanks, Rick. Yes, there's only one mortgage payment, correct. Ed asked, is there only one mortgage payment? The rest is investor down payment, and that is correct. Yep, so the current ownership group actually owned this property since 2011, I believe. So it's a little bit longer.
So I got that wrong.
Yeah, so they owned it in 2011, and then they did that refinance in 2018. That's where the appraisal came from. Let's see, will the improved landscape increase the cost of maintenance? So the improved landscaping should not increase the cost of maintenance. The contract is still applicable. And so we have some fail safes built into our CapEx budget where we always try to be overcapitalized on the CapEx front. So if we need to put a little bit more, the $30,000 that we have budgeted for landscape, that doesn't mean we're throwing $30,000 at landscaping year one, day one. That's meant to put in the initial landscaping and then kind of maintain it over the course of the hold. Current economic occupancy and their tenant. So we have a question about the current economic occupancy on this property. So right now the current economic occupancy, well, let's talk in terms of economic vacancy, is around 7%. Part of that, they do have some Section 8 tenants that are in there currently. We will not be renewing Section 8 leases. So there's about 25 Section 8 tenants in currently that were grandfathered in. We will not be renewing those. Currently for a 2-bedroom, Section 8 only pays $585, and that does not fit our mold, nor is our strategy here subsidized housing. So we will not be renewing those leases when they come due. Tenant that can't be evicted that satisfy the CDC moratorium. Yes, so again, if they truly qualify for the CDC moratorium, correct, they cannot be evicted. They will. The good news is we're closing December 18th, and the eviction moratorium is slated to be lifted on January 1st. So anyone that's in arrears will have that due January 1, essentially, or end of December. And if they are not able to pay to catch up, that is not our bad debt. That is the previous owner's bad debt. And we will be able to evict them virtually immediately and wipe the slate clean. So that's a nice win for us. How many units renovated per month? That's a great question. So our goal is to do between 40 and 60 units in the first year. So the primary way that we plan on tackling this is taking the current vacant units upon takeover, and we're going to renovate those first. As soon as those are renovated, we'll offer those renovated units to the current tenant base, give them the opportunity to break their current lease, move into a new renovated unit at the new market rent pricing. That will free up. So say we have 16 vacant units day one that are renovated, and we have 16 tenants that move into those 16 units. We will then in turn have 16 more vacant units to wash rents and repeat. So the goal is to do 40 to 60 units year one, 40 to 60 units year two, and then the remaining units in year three. So per month, we're looking at 4 to 6 units per month, to answer your question. And again, keep in mind, these are not heavy lifts. We're talking about new paint, new countertops, new light fixtures, flooring, new handle poles. We're not talking about heavy lift. We're talking about getting in and getting out in 3 to 4 days. That's it. No, Ed, so Ed asked, he saw that there were reserves to begin with. That's $200,000 in cash reserves. In addition, we have repair and reserves to cover maintenance. So we have both. If you look in our pro forma, Ed, we have both repairs and maintenance costs, and that includes turn costs as well in our R&M. And then we also have this down here is $250 per unit annually. So we'll be adding $40,000 back into our reserves budget each year for unforeseen capital expenditures that we didn't budget for initially. Let's see. Typical R&M is, yeah, Arn addressed that. There was a 3% acquisition fee. Is there another fee for sale? No. So great question, Ed. We do not believe in disposition fees. We have an acquisition fee, and part of that is because we have to put up the risk capital on this. So between all of the GPs combined, we had $75,000 in earnest money initially, plus $75,000 per extension. We're about to have to burn our first extension just because Arbor's taking longer than we would like to get the loan assumption process completed. And part of that's just COVID. It is what it is. In addition, we have travel expenses to get on site. We have to pay contractors to come out. We have to pay for environmental studies. We have to pay for appraisals. There's a ton of stuff that we have to pay for on the front end that we put at risk if the deal falls through. And so that acquisition fee is to basically compensate us for the risk that we took by putting all that money on the line. So we don't do a disposition fee. Our disposition fee is if we did a disposition fee, it doesn't matter how well we perform, we would get a bonus on the back end regardless of performance. Our disposition fee comes in the form of the hurdle and that 12% or 72% return to you. At that point, then we get a disposition fee via the hurdle where we get a little bit fatter chunk of equity on the back end at sale. OpEx efficiencies coming from, yeah. So the OpEx efficiencies are coming from really a couple of different places. The primary place, if you look in here, everything's going up, but the places where we see OpEx efficiencies coming in is through R&M, because we're going to be able to one, we have 8 other properties that we bought this calendar year, or 7 other properties we bought this calendar year. So we are buying massive amounts of flooring and paint, and we're able to take advantage of all that and buy in bulk, and SDMC manages all of those properties for us. So we were able to get discounts through that. Also knowing that SDMC is right down the street and they have full-time management staff at High Point Crossing, if we need to bring over part-time help to help with turns or help with renovations for a small period of time, we can do that very inexpensively. So that's a great place that we're able to take advantage of operational efficiencies. The insurance, by having the traveler's multifamily policy we have, that's going to allow for bulk discount in insurance. That's an operational efficiency. And then the taxes, that's not really an operational efficiency, but it's an area we built in kind of a fat cushion that we know we're going to be able to come in under. I hope that answered your question, Ed. Philippe asked, will your level of renovations bring the units to market standard level or above market? So we're actually going to be right at the top end of what the current C-class product will be. So by having LVP flooring and by having the satin nickel finishes and having the new countertops and new appliances in, we'll be in the upper, we won't be at the top, but we'll be at that 70 to 80% range of what the other comparable properties are. Again, it does two things. It allows us to keep our CapEx budget low, and it leaves meat on the bone for the next group that wants to come in, put an additional bolus of capital in, and push rents on the backside. Fannie Green loan, Philippe. So all the requirements for the Fannie Green loan that we're assuming have already been hit and have already been checked off. So there's nothing else that we have to do to maintain that criteria. And yes, they passed the inspection on that. And no, we are not invested in any other multifamily in Augusta. Augusta has been a market that we've been trying to get into for about 18 months, and we just weren't able to find the right product that penciled out nicely. So that said, our management group owns 171 units right down the street. Another group in our general partnership owns a property about 2.5 miles away in Augusta. We own properties in Columbia and in Greenville. We own 6 properties in Greenville. So while we are actively looking for additional properties in Augusta, because we would love to build up a portfolio in Augusta, currently that is, from a Four Oaks perspective, that is our only property in Augusta. And Arn just said, spoke to another syndicator who's paying 80 plus per unit in Augusta.
Today.
I want to show you this. So this is another deal in Augusta that just got sent to us called Fairway Village. Let me show you this real fast. So these are the comps from sales in 2019 of other C-class assets. I know I'm flying through this quickly, but I think it's important that you see this. There we go. These are comps. Look at this, folks. Sold, all these are 70s vintage with the exception of 1 or 2. 70s, early 80s vintage that sold in the last 12 months. 61 a door, 66 a door, 58 a door, 70 a door, 67 a door. We bought this at 42 a door, and we're looking to sell. What are we selling for per door?
I think 74 a door.
I think it's 74 a door. I think you're right, Rick. Yeah, it's 74 a door.
But that's in 6 years.
Correct. 74 door in 6 years. This other property, these other comps, this is what sold in the last 12 months. So a 72 vintage property sold for $70,000 a door.
Yeah. Eric, can you give me screen share? I just want to put up a slide and kind of bring home the importance of the cap rate.
Yep, absolutely. It's yours, Arn.
Okay. So let's see. Can you guys all see this? Eric, can you see it?
No,
we cannot.
Hold on. What do I need to do? Hold on.
Arn, while you do that, I'm going to answer. Philippe had another question about the other property about Four Oaks. So as of right now, we have 7 other assets. Every single asset, we are outperforming our pro forma. And in some cases, we're already hitting year 3 pro forma numbers in year 1. But we are outperforming pro forma with every single asset that we own in times of global pandemic. And the reason that we're doing that is because of this type of underwriting. We build in these massive cushions. We just closed 2 weeks ago now, I think, on a 82 unit in Clemson, South Carolina. Same thing. It's currently at 8% occupancy, or excuse me, 8% vacancy. We have baked in 25% vacancy in year 1. So this isn't just something we're baking in for Augusta. We're doing it across the board until the market stabilizes a bit and we feel comfortable being more aggressive in our underwriting.
So can you guys see that now?
Yes.
Okay. So let's just do some math because I want to show how this cap rate works. So at the end of year 6, we're projecting $869,455 in net operating income. You divide it by 0.07 cap rate, so you get a sales price of $2.42 million. All right. Let's see what the sales price would be at a 6.3% cap rate. So I take the 869,445, 0.063 divide. We're talking $3.8 million sales price.
13.8.
13.8. Yes, thanks, Eric. So we're talking about dropping the cap rate from 7 to 6.3 increases sales proceeds $1.4 million. And that's on a $4 million investment.
And keep in mind, of that $1.4 million, and even once we hit the hurdle, it's still a 75-25 split. It's 75% of that $1.4 million going in your pockets.
Right. So because I think it's important for people to understand how a minor change in cap rate can significantly affect the returns. We could have easily presented this at a 6-point cap rate, and investors would be getting another million or two, $1 million+ dollars. Being conservative, we should be able to do better.
Yeah.
Yep.
Can I just add?
So I'll give you the screen back.
We're over an hour now, but I think the main takeaway, everybody's head's probably swimming from looking at all those numbers and those spreadsheets, but there are a lot of different areas in the deal where we can improve upon, and a lot of deals I've been seeing the last year, they're razor thin for going up, landing north of their projections. I foresee a lot of those deals landing south of their projections, but the way this deal's been underwritten, there's a lot of margin for improvement, and that's why we feel really excited about this deal. Very excited about this deal.
Yep. So just so everyone knows, we're slated to close December 18th. Arn and Rick will reach out to everyone about soft commits, but the soft commit window will open up this evening. I can tell you the last 3 deals we've done have been fully funded within 48 hours. So if you like what you see and you want to get involved in this project, please don't hesitate to let us know sooner than later, just to make sure that we can reserve a spot for you, because I'd hate for you to be on the waiting list.
And anybody who wants to talk in greater depth with me about the investment and all the numbers, happy to have a conversation with you to go through it and answer any questions you have.
Yeah, and I'll just say, there's going to be a recording provided probably tomorrow. That link will go out. If you want to live it all over again, you're welcome to. And just want to thank you for coming out tonight, because I think a lot of people are just waiting for that recording. And I think it's good that you were here live and you could ask your questions. So thank you again.
Yep. Thanks, everybody. Have a great night, and we appreciate your time.